Hi everyone, and week 2 InvestSMART Bootcamp webinar. And this is the second time so far that we've had the week 2 bootcamp webinar running. So you can always watch the previous week's episode, which is uploaded straight onto the bootcamp, usually the same day. So you can always hop into there and have a look at it and re-watch it. My name's Tom Wilson. I'm one of the product specialists at InvestSMART, and also I look after the bootcamp. So the purpose of this webinar is to definitely go through anything else that you might have questions about, or if you needed better understanding. And it's the week 2, so it's covering off module 3. And let's get started. So on the right-hand side, at least for me, there's the go-to webinar control panel where there's a questions area. So as we go, you can always pop in any questions that you've got and I'll have a look at them, try and get them answered. You can put comments in there as well. If there's a question that I can't answer on the spot, I'll go away and get some more information, or even ask one of the resident experts at InvestSMART and get back to you, probably by email as well. So start off with a disclaimer, as we always do. The advice that we give is just general only. It can't be specific. So it's not specific financial advice. And I can't take any questions that relate to any kind of specific situations that you might have. If a question does pop up, I may not answer it, or I may try and rephrase it in a general term. The point of these webinars, it's basically to cover off any questions that you might have once you've gone through the learning material. We don't give any financial advice, which is what we've already covered. We need to stick to the course content. So this module is about module 3, and we'll kind of stick to that area. There's questions that come up that I can answer quickly, and it's quite helpful for understanding something in this module. We'll definitely have a look at it. But if there's questions about future modules or even previous ones, I might refer you back to that content and that existing webinar recorded video that's uploaded. This is also to make sure that you're using the available resources. So there's so much that you can use alongside this. The Intelligent Investor website and Eureka Report is a massive resource that I definitely recommend that you use. I use it myself daily, hopping in there and brushing up on different things or reading latest research. So we'll have a look at that too. And just remember, this is an introductory course. We're just covering the basics. So we're not going to go into too much detail. I can point you in the right direction. If you've got questions about something like value investing, you want to know specific ratios, I can point you in that direction. But it's not something that I'll sit here and go through in fine detail. And a bit of a shameless plug, we've got another webinar that's coming up. You might have seen it in the bootcamp course. It does sit in the module 3 content where you can register. So during the COVID pandemic, Evan Lucas, who's the chief market strategist, and myself and other guests from time to time, we were doing a webinar called From the Bunker. And it was actually very popular. We had a lot of clients and people jump on there and ask us to look at topics and questions that a lot of them didn't know much about or wanted us to look into more detail. We've tied it in with bootcamp, which is fantastic. So what it means is that we're going to have a look at other asset classes, because I get a lot of questions myself, even when I talk to clients about asset classes like gold ETFs. I had a gentleman ring up just actually this week and chat to me and ask me for my opinion on those kind of asset classes or investments. I don't myself cover off that, and the bootcamp doesn't either. But what we can do with this webinar coming up tomorrow at 10 a.m. Sydney, Melbourne time, is we can put them to Evan Lucas, and he'll actually be able to answer those, give you his opinion on different asset classes, and maybe even cover off ones that you haven't considered or you haven't seen in the bootcamp content. So you can register on that link under module 3 of the bootcamp. You can also go to the events page on the InvestSMART website. What I might do is quickly grab that and I'll put it into this chat here. So the events is actually at the bottom, the very bottom. So I'll click on this, find out more. And what I'll do is, you could go to that page yourself, but I'll just copy it and I will put it into the chat so you can actually just go there straight away and register. This webinar is actually free and it's available to everyone. So you don't have to do the bootcamp to be able to watch this webinar, but it will tie in strongly a lot to the bootcamp content. So as boot campers, it's quite helpful for you because you already are going through this module, and it will give us, I guess, extra information that we might want to consider. So that's tomorrow at 10 a.m. and we'll also upload this to the website, and I'll also get a copy up on the bootcamp course as well in case you want to watch it later. But as always, you can ask questions before, pop them into the registration page, and we'll tackle them as we go, and you can watch it in your own time. So let's recap week one. So week one looked at modules 1 and 2, and basically what we're doing is we want to have a good plan, a good investment plan. So I always use the example of saving for a house deposit, which is something I'm trying to do, and that's my goal. So I've got a clear goal, saving for a house deposit. Time frame for me is going to be 3 years, which means that I need to choose an investment strategy that's going to fit within that 3 years. I don't want to choose something ultra risky that might get me a good return quickly, because there'd be the risk that I would go backwards. So looking at that third part is risk. I don't mind risk, but I don't want to have less money than what I start with, especially for a house deposit. So diversification, I'm going to spread that risk across a different number of asset classes, such as shares, international shares, fixed interest, things like that. In terms of asset allocation, because I'm going to be fairly conservative and my time frame is quite short, 3 years, I'm going to probably have to go with some kind of conservative type approach. So in terms of percentages, a lot of it's going to be put towards defensive type assets, such as a fixed interest or some kind of cash at bank or term deposits, things like that. Not massive return, but defensive, and it'll help me a little bit grow my money, and we'll have a bit of my money put into things like Australian shares, international shares, property infrastructure as well, but much smaller percentages. So this module is module 3, and we're looking at different investment vehicles. And I guess that's just like a fancy way to say different things to invest in. We tend to use odd terms sometimes in finance that you've probably noticed, and it can get confusing, but we're just basically trying to work out what are the different things that we can invest our hard-earned money into and have it grow, or at least in some circumstances not go backwards. We do have a question here from Yongping. Hi Yongping, I'm well. Handling the Melbourne lockdown. I'm in Melbourne, so it's not too bad. But thanks for joining us. You've asked a quick question there. What class of asset is OOO on the ASX? So that's Oscar is the ticker code. I just did a quick search myself because I don't know all those codes off by heart, and it's an ETF, so an exchange traded fund. So we'll definitely look at ETFs in this webinar, and it's an ETF that's put together by Better Shares. So Better Shares is an Australian company that actually is an ETF provider, and this is something that you would buy and sell on an exchange. So you'd go to your broker, say you might use CommSec, and you could purchase that ETF. So you could type in OOO, search for it, get a price on the market, and then buy or sell it. So that's a great question. Thank you for asking that. And if you've got any other questions, definitely pop them in there and I'll look them as we go. So there's different types of investment vehicles we're going to look at. There's the shares and ETFs, exchange traded funds, which we briefly touched on, managed funds and managed portfolios, and then there's also cash and bonds. So with shares, you generally profit when you buy the share at a certain price and it goes up in value. So that is what we call capital appreciation or capital growth. That's one way to profit from, say, a share trade. The other way is through income being paid out. So because you're the part owner of that company that you've bought, you get a share of their profits. So that's called a dividend, and it's paid out to you, paid out to the shareholders. Not all the shares pay a dividend. Australian shares are generally pretty good at paying dividends, whereas you look at some US shares or a lot of US shares, and they don't tend to do that. And it's a very interesting argument for both sides. One is that in the US, they retain all of their earnings, but they put them back into research and try and grow the company. Whereas in Australia, a lot of people say, well, the company's making that money, it should give it back to shareholders. So we don't tend to see as much reinvestment into the company or other ventures that they might have. And in fact, one of the From the Bunker webinars that we did, we spoke with Nathan Bell, who's head of research at Intelligent Investor. He was talking about how a lot of the banks in the past had done a lot of investments or ventures themselves, such as going overseas, buying other banks, opening up in new markets. And their track record wasn't that good. So he is also of the view that maybe they should just pay it back to shareholders, where at least we can perhaps do something better with it ourselves. The biggest thing with shares is you'll need a broker to trade. So like I mentioned, you'll need to have a brokerage account with a company like CommSec, for example. I purely use CommSec just because I guess it's fairly well known. They can have higher fees. You definitely want to have a look at the brokerage charges. And that brings us to the point 2 and 3 here, is that brokerage is charged when you buy a share, and then brokerage is charged when you sell a share. So the in and out of owning that asset, it can start to stack up over time. And I know from my previous experience, I used to work at a broker, and we had a lot of clients that would do very, very short-term trading. So they would be in and out of a trade, sometimes in a matter of hours, or they'd be even day traders. So they'd have a daily type holding, and they'd get a profit, but a big part of that would be eaten up by the brokerage charge. So there's one thing you always need to factor in is, I guess, the costs of the transaction, the cost of trying to make that profit. There's so many different strategies involved with share trading. Most popular ones are like value investing, which Intelligent Investor follows, and they talk about, and they even write about it on their website too. And then there's growth investing, and there's others as well, such as even technical and analysis as well, where people use charts to trade. So there's a lot of tools that you can use that we offer. In particular, the Intelligent Investor has the share recos, so share recommendations. They've got their research. They use a model portfolio. They've also got their question and answer section. What I might do is quickly show you what I'm talking about. So up here is Intelligent Investor. You can click on that and it will take you to their website. You've got, as part of your bootcamp access, you've actually got 1 month complimentary access to Intelligent Investor and your weekly report. So you may already be a subscriber, which is fantastic. But let's have a look. So on Intelligent Investor, as an example, you can see there's some recommendations here, but you can also go into the full area here and see the latest, the buy, the hold, the sells, and also their approach on value investing. And this is their strategy that they use, and it's quite detailed. So you can read through that and even see what they mean when they talk about things such as, what does buy mean? What does hold mean? And they talk about when to avoid and what price ranges to purchase in. They also have their research, which you can obviously see here, and they go into so much detail listing results as they come through. BHP, Coles, obviously yesterday. They've also got their own portfolios. So you can see here they've got model portfolios. So if you ever wanted to have your own brokerage account, say through CommSec or NavTrade, you could come to here, look at their growth portfolio and see what they're holding, see what percentage it makes up that portfolio, and then you could decide yourself to follow that as they trade. So you can see here that they've got 14% in cash, and then they've got the IT sector, it's covered off by Audinate, Class, for example. And they show you the ratings, and they also show you the percentages. So you could follow that. Alternatively, if you didn't want to, and we'll talk about this in a bit, you could have a managed type portfolio where it's done for you. So it's something like looking at growth, so equity growth. When you are reading an article, you can actually question straight away at the bottom here. And the analysts like Graham, they are very responsive. So you can actually ask questions directly to them and they'll do their best to answer. So ETF's an acronym, as you probably already know, Exchange Traded Fund. It does sound a bit technical, it can be a bit scary sounding. It's basically just a fund that's trading on an exchange. So for example, on the ASX, there's numerous different ETFs, such as the one that Yongping was talking about before, which is the Better Shares Oil ETF, and that trades on the ASX, very similar to how a share trades. So it gives you a buy-sell price. You're buying units. You're not buying shares of the ETF. You're buying units, and it pays out a thing called a distribution, which is very similar to a dividend, but in that distribution, it's representing any income or interest, such as dividends or interest paid, and they call that distribution. There's different types of ETFs. There's active and passive. So ones that are actively managed, you've got people behind it deciding to buy and sell different things. And then you've got passive or index trackers, ones that are cheap to own, the management fees are low, and they are just trying to get the same return that the market gets. So it's tracking that, less any fees. There's a wide range of ETFs, which I've listed here. But essentially, if you do a search, and we've got tools that you can do this with, which I'll go through, but you can actually, such as the oil one that we spoke about before, that one would be designed to give you exposure to the oil market itself without having to go out there and purchase commodities or contracts for difference. It'll give you exposure to that area. So a good example, with our investments, our managed portfolios at InvestSMART, we want to get exposure to the top 200 ASX shares. So for example, you've probably seen on the news each night, Alan Kohler might talk about the All Ordinaries, and he might talk about the S&P ASX 200. That's the top 200 shares by market cap. So the size, the value of those companies. I could go out and buy each one of those companies through a broker. If I did it through CommSec, for example, I could do that. I'd pay at least $20 per trade just to buy each company. So that would actually quickly add up as I went through my list of 200. The other thing you could do is buy an ETF, which wraps up all of those different shares into the one product. So for example, BlackRock, they themselves, and we use them ourselves here at InvestSMART, they will go out and they'll buy those 200 shares and they'll wrap it up into an ETF product, and that will trade on the exchange, on the ASX, at a price. So that gives us exposure to any kind of movement in the ASX 200. So it's tracking that index, less any fees that BlackRock might charge to do that. You get dividends, of course. So when a company like CommBank, car sales pays a dividend, you'll get that in the form of a distribution. You'll need a broker again, because again, it's very much like a share to trade. You'll pay brokerage on the way in to buy it and on the way out to sell it. And as we've seen, there's different types of ETFs as well. I'll show you the Eureka Report tools. One thing when I talk about different ETFs, there are some that you might see that are leveraged. So it means they actually use a form of, inside that ETF, they'll borrow money to make the size of the positions they hold a bit larger. So leverage can represent a bit more of a riskier type investment. You tend to have magnified gains if it goes correct for you, but you can have magnified losses within that ETF. So just be wary of that and maybe do a little bit more research and read about it. Each ETF provider, like Better Shares, BlackRock, they all have a lot of detailed information on their websites, covering off PDSs, so product disclosure statements, and also what is held inside those ETFs. What are the underlying assets or investments? The other thing is too, you might see some with the words inverse in the title of the ETF. And that means that sometimes, for example, with a gold ETF, you might want to say buy it and you are hoping it goes up. With an inverse one, you actually profit when the price of gold goes down. So it sort of flips that for you. So that can be a little bit confusing sometimes. So just be wary if you see that. So you'll also see others with like a magnified number, like 2 times or 3 times. That's something you have to be wary of too. So I'll show you quickly the Eureka report tools. So you've got the filter tools at the top, and obviously there's the shares. You can see dividends, direct interest, which is really interesting to see directors who buy and sell into their own companies. Can be a good indicator sometimes if you're that way inclined. But let's have a look at the exchange traded funds. So I'll click on that. And what I can do then is I can search for all the different ones that are available. And I don't think I can search via, if I tried oil, for example. So here's the one that Yongping was talking about before, which is OOO. And it's a Better Shares Crude Oil Index ETF, and it's currency hedged, which means that it's trying to offset the risk in any kind of currency fluctuation. So if the US dollar goes up or down, they will make sure that it doesn't affect you as much. We give you all this data is from Morningstar, and we give you a rating here as well. Some of the costs, management expense ratio, and the price it's currently at or was at as of last trade, and the market cap, and then different yields, so different returns. So you can click on that and it would actually even take you into the next section, which gives you a bit more information along with any kind of research that we might have done here as well. Sometimes Alan Kohler will interview different fund managers or CEOs or innovators, and that's a really handy place to find that information. You can see Better Shares websites here. So if I was to click on that, that would take me to the ETF provider, and I can see so much more detailed information because they're legally required to publish that. The Ask Alan section is very popular as well. I would definitely say make use of this as a boot camper, because you can ask questions direct to Alan. Obviously, depends on how busy he is, but every Thursday he does a Q&A. I don't think it's live anymore. I think he records it, but you can pop your question in there, put your name in like I have and submit it. And you can even see straight away there's an existing question here, ETF portfolios for kids. And Richard's asking about how he started putting together an ETF portfolio. Well done, Richard. And he's talking about different, so he's got tickers here, so IOZ. He's talking about the different mixes that he's got. What should you do? And Alan's written back and given his 2 cents. So that's a really handy feature while you've got access to Eureka report. And if you decide to keep it in the future, definitely ask Alan as many questions as you can. And he even refers it to the other experts that he works with. Elizabeth Moran, who we'll touch on in a little bit, she is fantastic when it comes to talking about fixed interest or bonds. And she's even published an article today, which is fantastic because it saves us so much legwork looking at which bank is offering the best deposit rates, which unfortunately probably not many do at the moment. But I'll hop back into the slides. And Susan's got a great question here. Are there any ethical ETFs? There are. And what I might do is even just go back to that filter tools. And fingers crossed, if we type in the word ethical, we should get a few hits. It'd be disappointing if we don't, because that means there's none. So there's Vanguard. Vanguard has an ethically conscious international shares index. So that's fairly specific. So Intelligent Investor, which is obviously an InvestSMART company, we've got our own as well, which is INES, INES. If I was to go to the Vanguard website, I could get much more detailed information. I know that if I go to the Intelligent Investor section, if I go up the top here and go Portfolios, Ethical Share Fund, INES, and click on it, it'll give everything here that we need in terms of what it is investing in, but also the product disclosure statement. It will talk about what kind of criteria it uses that it determines as an ethical investment as well. So that's all been listed in there. You can see the performance. Obviously, there's been the dip during the COVID pandemic, but a lot of the ethical investments, they tend to have done quite well over the long term. And this is what this is as well. The suggested time frame is 5+ years. So what you could do is go to your broker. So log on to, say, CommSec or NavTrade. If you typed in INES, you would see the buy and sell price for this ethical share fund. And then you could decide to purchase it, hold on to it. Obviously, it's a long-term approach, so it's recommending 5+ years. But there was also, as we mentioned, there's Vanguard. And Vanguard's another company that packages together a number of different ETFs as well. So we can click on this, and it will take us to a bit of a rundown. We go to their website and we could look up VESG, and that's the ticker, the ASX code. And that would give us all the information we needed about what it is comprised of, what actually determines an ethical or sustainable type share, and we could go from there. That's an excellent question, and I think it's something that is becoming more and more popular, definitely with a lot of investors nowadays. And I think it's a good thing. So a managed fund, that's the next step. How do they work? Well, you've got a pool of investors, and basically what they're doing is they're pulling their money together, having a manager to manage those investments for them, and you end up owning one piece of that managed fund itself. You've got listed investment companies. So what they do is they'll trade on an exchange. And a really good example of this is Warren Buffett's company, Berkshire Hathaway. So they have numerous different investments inside them, such as Coca-Cola, Apple, mostly Apple, if you have a look at the breakdown of what they're holding. But they are obviously incorporated, so they're a company, and then they trade on an exchange in the US. So you can buy and sell, and you're getting exposure to those investments that they hold. An unlisted managed fund would be something like perhaps like a Charter Hall real estate fund, where what they're doing is they're asking you to put money with them, then they'll go out and build office buildings or commercial buildings, for example, and you're getting exposure to that project. It's unlisted because it doesn't trade on an exchange. So sometimes you may not have the best idea of what the actual real market price is. The biggest thing with funds, the managed funds, is you've just got to be aware that sometimes performance fees can be charged, and they can be high, and they can also have the criteria of how they're performing can be a bit opaque as well. So for what I mean is, you might get a company that will say, as long as we do better than what the Reserve Bank is offering, then therefore we meet our performance fee, so you're going to pay us this much extra. And obviously the Reserve Bank overnight interest rate is at all-time lows, so that could be very easy to beat at the moment, and you could find yourself paying much higher fees. Some of them obviously would pay uncapped, which means they just put a percentage on. So whatever your investment amount is, say 100,000, they might say each year we charge you 1%, 2%. There's a question here that was submitted before the webinar from Kenneth, and it's what are the pros and cons of LIC, so listed investment companies, with managed funds or ETFs. There's a number of advantages to investing in an LIC. It usually is a low-cost option when it's listed like that. Probably less than what you'd encounter with, say, like an unlisted managed fund, what I was talking about just before. It's a really quick way to, I guess, get access to a number of different products. So if we look at the Berkshire Hathaway, if we were to buy something like that, we're getting exposure into a number of different companies inside it, such as Coca-Cola, Apple, and all the other little ones that they've invested in as well. So we're not direct owners of those underlying investments, but we've got exposure. So when they move, it will affect our investment. So that's a fairly cost-effective way to get a diverse range of investments. You'll find that if you're more focused on income, they'll pay distributions or dividends, so you'll still receive those as well. The thing with the LICs is you probably shouldn't expect any kind of massive growth in the short term. It's usually just like that ethical fund I was talking about before, the intelligent investor. They tend to be more long-term, which shares just naturally are. You've also got to consider market risk. So one of the biggest risks with LICs is because they usually offer only a fixed number of units when you're buying into them, that can be a problem when it comes to liquidity. So what that means is that, just say on the off chance that no one is prepared to sell the shares out of the investment company, it might be hard to buy into it. So that might push the price up. So that means it's a bit illiquid. And the flip side is that if you wanted to, say, sell immediately and get out of it, if there's no buyers to your holdings in that LIC, it could be difficult to sell. So liquidity is one risk of an LIC, whereas with ETFs, how they work is, let's have a look at the example we used before where you've got a company like BlackRock, they have an ETF that represents the top 200 Australian shares. If someone comes in and says, I want to buy this many ETFs that you're holding, and if they don't have enough on the actual market itself that are trading naturally, they can make more. They can literally go out and buy those 200 shares, package them up, and then have another ETF. So they're much more liquid. The ETFs tend to be much better value for money in terms of lower cost, in terms of management fees. Brokerage would be the same if you're buying into an LIC, depending on, I guess if it's international or domestic. But ETFs also give you access to a diverse range, which we were covering off before, a number of different types of investments, such as oil, which Yongping was talking about, the ethical type investments, or even just index trackers as well. So we've got tools on Intelligent Investor and on Eureka Report. So that was the example here that Susan was talking about, the INES, Intelligent Investor, Ethical Share Fund, and then you've got Eureka Report where Alan interviews different CEOs, managed fund managers, different filters, and we can also search on the filter tools. I'll just quickly show you that as well. Eureka Report filter tools, and you've got managed funds and listed investment companies, just like how we used the ETF one before. So basically, the next part here is a managed portfolio. So it would be the same as if you've got your own portfolio. So you've gone out and you bought, just say, Australian shares. So you bought some Commonwealth Bank, some BHP, Wesfarmers. But instead of you having to sit there and manage those buy and sells, you'd have someone doing it for you. So that's a managed portfolio. There's different types, active and passive. Active would be having someone or a team behind those decisions where they're actively buying and selling each day, trying to outperform the market. A passive one would be just buying the right mix of shares that just tracks that market itself. With the managed portfolios, you own the underlying assets. So if you ever decided to transfer out or make another decision, it's quite easy. There's no capital tax events usually in those circumstances when you transfer out, as opposed to if you left a managed fund or a listed investment company, you usually have to buy to get into it, then you have to sell at the price to get out of it, which can trigger different capital tax events that you could just want to be aware of as well. You've got to be aware of, again, fees. Some of them charge uncapped, some charge performance, which we were talking about before. I'll talk about our products because I'm familiar with them, but we've got an example of the InvestSMART diversified capped fee products, and they're passive. So what they're trying to do is just get the same return as what the market is giving, not trying to outperform. But what it means is that history has shown that the markets have done quite well. So if we're just going to try and track them and get the same, we should do quite well in terms of our investment as well. And we diversify those across different kind of asset classes. And I'll jump into that in a second, show you. The alternative is Intelligent Investor, where we looked at before, that equity growth. That's an actively managed. So Nathan Bell and his team of analysts are sitting there and actually looking at all these different opportunities, and they're jumping in, buying this, and then they're buying another one. They're waiting for some other opportunities. They're selling this. Usually you'll find because of that extra legwork and a team of people behind it, you will pay a higher fee. I'll show you, for example, what I mean by the InvestSMART portfolios. If you go to the InvestSMART website, at the top, you've got Invest with Us. I'll click on that, and you've got diversified portfolios. So I go to balanced, I can click on it. You can see here we've allocated certain percentages of your funds to different asset classes. And if I go to allocation, it actually shows you what percentages, but then what you would be holding. So you would be owning these holdings here, and they're all ETFs. So they give us exposure to all these different markets, international shares, including Hong Kong, USA, UK. We can do that just by buying one ETF. We already looked at it briefly, but if you looked at the equity growth managed portfolio, this is where they've got the team of people who are actually in the background buying and selling, and it shows you all the different percentages again. But in order to see what you're holding, you'd need to be investor or go up to that growth portfolio part here. You can see how we've got the INES and INIF, which trade on the ASX. So we're actually in the process now of listing this equity growth portfolio. So you'll probably see the top here, it says find out more. I'll click on that just to give you an idea of an example. So this isn't on the ASX at the moment. It's going to have the stock code of IIGF. But what it means is that you can, obviously you'd read the product disclosure statement here in the fact sheet, but you could register your interest. And what that means is you could say, okay, the application price is going to start off at $2.50. You have to have a minimum application amount of 1,000 units, which is 2,500. You can apply for more depending on what your investment strategy is. But you don't pay brokerage. It's covered off because this is part of the actual listing. And then it'll have dates here as well. So that will open on the 31st. The offer will close on the 25th, and then we expect to list it on the ASX on the 5th of October. So when it does list, you're accepted for your application, because it's actually limited to, I believe it's $100 million. They aren't going to go above that. But if you're successful, then you would have however many holdings of that, and it would then trade on the ASX at market. But you can always definitely contact us at InvestSMART if you needed more information about that. But It's on the website, and it's also emails being sent out too. It's in the past been fairly popular, so just see if it fits your investment requirements. So cash and bonds is the last one. We particularly look at risk-free, which means there's no risk that your capital won't be returned to you. In particular, common ones are term deposits and savings accounts, which you've probably all heard of. There's also government bonds as well, which trade on exchange, so on the ASX also. And you can even buy ETFs that have government bonds or other bonds wrapped up inside them. And I was telling you that Elizabeth Moran at Eureka Report, she's written a lot about this. This is her area of expertise, and I find this quite helpful because it's not my strongest part of my knowledge. And Elizabeth writes so many good articles that even today she's done a quest for the best deposit rates, and she's talking about how she's looking at different term deposit rates here, and then she starts to go through each one, which is so handy, giving her 2 cents as well about whether or not it's worth it. There's deposit guarantees as well, which is the government's backed guarantee. It's she's given her conclusion that it seems too hard, but it's a really good read. So I recommend that if you're someone who's looking for something like that, definitely have a read through. And you might also make the most of the Eureka Report subscription if you're not a regular subscriber. And Elizabeth Moran's got so many other articles about defensive type investments, such as bonds, company bonds as well. Basically, we've reached the end. And if you've got any questions, definitely pop them in here. I'll just wait for a little bit in case we do. Otherwise, you can always email us at bootcamp@investsmart.com.au. Here we go. Sam's got a question about ETFs, which is fantastic. So regarding ETFs, when returns are mentioned, I assume it's capital growth. Returns will cover off capital growth and any income inside it. So that will count towards how much return that ETF is given for that period. So let's just choose a year. So if you said that this ETF has gone up 10%, the performance was 10%, that'll usually be a mixture of any kind of capital growth, capital gain, or any kind of income, such as interest or even dividends that are paid into that, because they'll usually always include that. So it's paid back to you. You can actually receive the distributions, but in some cases you can reinvest them back into it, but they'll always generally show you returns that will have capital growth and income wrapped up into it. Just to show you a little bit of a difference, what we do when we talk about our managed portfolios, so these are a little bit different because they've got a number of different ETFs inside them. We'll put down, so here, for example, let's have a look at just the conservative. So 4.1% performance, and that's backwards looking. So that's so far how well it's done, how well it's performed. And that's going to comprise of both capital growth and any kind of income that's been received as well. But then we also give an estimated income, and this is forward looking. So what we're saying is that when you buy into this portfolio, when you own it, you should expect about 2.3% in income per annum, and that will be a mixture of dividends and also any kind of interest from fixed interest products that are in that portfolio. But this will show you a mixture of the two. It will show you how well it's performed. And ETFs will do a similar thing as well. They should be able to give you an indication of what they expect for income, because especially with interest products, that's fairly easy to anticipate. And companies, they usually have a fairly good idea as well. Well, what we might do is wrap it up there. I appreciate all the questions that you've got. If you've got comments as well, definitely leave some feedback. And if you do get through the course and towards the end, you will be asked if you want to put some feedback there too in the form of a review. I'd love to hear from you. It's all about trying to make this as easy as possible and approachable, down to earth, but at the same time making it somewhat interesting. Excellent. So thank you so much. Really appreciate it. And we'll see you next week. Bye-bye.